Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So this week we have a little bit of a change up because Monday was the holiday, so the EIA data will move to Thursday. So we're going to you're going to see the econ show today, and then tomorrow we'll have our EIA show. So when we look at the econ data, there's a lot of things that were coming out over the last couple of days. The most concerning one, or the one that we're going to talk about the most, is really the PMI data. What is it telling us in terms of the internals? What does it indicate for inflation? Or I should say, which part of the cycle of inflation are we in? Because, the one thing that we've been talking about is how inflation is going to give way to a stagnation, then a deflationary cycle, and met with renewed inflation. And we're just looking at where is that pivot point, and that's why we go down the whole supply chain to look at where is pricing, how far has it come down, and where are we going to go from here. So in the first segment, we're going to look at global consumption. How is it changing? What is PMI saying? How are things going to look post-COVID? Then we're going to turn to what is the US PMI telling us, because there's a lot of indications within that. How is spending adjusting underneath that, leading us into the most recent inflation GDP data? What does spending look like? And then we're going to turn into Europe and look at how some of the data has started to turn positive. All of the indices are now at new all-time highs, even though inflation is rising on just the reopening hopes. And it's just funny because you're at all-time highs, so you would assume some of the reopening was baked in because nobody thought you were going to stay down forever, but that's the world we live in. And then we're going to turn to Asia PMI and what does that mean for input prices. We're going to look at India, Vietnam, South Korea, and then we're going to extend over obviously into China and talk about some of the recent data points that have come out. So then when we turn to the global side of things, first we want to kick off with Africa. And obviously Africa is a continent. There's a lot of things behind it. But we just want to talk a bit about some of the key areas within it, because one of the things that we talked about in 2017 and 2018 was the rise of, or the coming increase in terrorism in some political parties and the tribal entities within some of these nations, coming to a friction point again on a generational cycle basis, because we're coming to this key pivot point away from the last civil war, the most recent uprisings, which happened in late 80s, early 90s, and now we're starting to get a renewed shift in some of these key areas, especially for not only just oil and natural gas and LNG, and specifically speaking of Mozambique, but also in areas that are really pivotal for the EV energy transition when we start talking about copper, cobalt, lithium, and some of the other key capacity or raw materials that really go to make that capacity possible. So this is, I think, an interesting chart, just looking at some of the levels where we have low-level insurrections that are currently escalating, and we continue to see that escalation coming up. More importantly for the Congo, when we think about cobalt and a lot of some of these raw materials that are pivotal. Libya is at a stabilizing level. Now, stabilizing is obviously relative, but when we look at, what is oil production going to do, we've seen a lot of stability come out of Libya over the last couple of months, and we see that continuing, where Mozambique is a bit of the opposite, where we actually see a big increase in terrorism activity. Some key nations have come out and said that they're going to defend some of the oil and gas areas, and especially some of the civilians in the region that have been subject to an increase in terrorism activity. So these are some of the interesting points that we're always going to look at in terms of understanding, where is some of that risk. Nigeria, Angola, and Nigeria has been seeing a big increase in some of these activities. But again, they've already seen that, and it's kind of been a bit of a stabilizing capacity. But that's going to be important because Nigeria needs a lot of investment in terms of infrastructure, new drilling, just trying to maintain the production that they currently have. So that's going to be one to watch on the oil and gas side. While Angola has been fairly stable, but they do need the investment on onshore, offshore, to make sure that they can meet the decline curves that have been coming, and that's why that's a big one to watch. And if you had to choose, Nigeria obviously has more to offer in terms of reserves, but Angola has a bit more of stability. So that's going to be ways to kind of weigh some of the activities there. With some of the other regions, seeing some decent investment over the last couple of years, which we should see accelerate just in terms of the area that has a lot of, or proven to have a lot of oil, some stranded gas, which could become interesting, especially if Mozambique continues on its current path. So that's going to be something to watch. But all of this is also going to impact just how much demand do they have for oil, gasoline, diesel, in terms of their development, which is why we talk about Africa a significant amount, because they're really supposed to be the next growth cycle after we look at Asia, which has been discounted in the market so far. And when we think about a lot of these areas, now this is shifting a bit into Eastern Europe, just considering what is the importance of inflation and the need for monetary tightening. And I think this is a good chart that's looking at the headline inflation, which is in the blue, and it's actually starting to trend either above or outside the intended range, because a lot of emerging markets or frontier markets will put inflation in a range where they're going to try to target something, but it's okay if it goes above or below this targeted range. And now you can see that they're really starting to push higher in terms of where they are in relation to that level, which is going to be indicative of the need for some monetary tightening. Now, it doesn't have to happen over, quickly, but when we think about what is going to happen coming down the pike, we've seen that there's a lot of inflationary pressures within the supply chain. So these numbers aren't really going to get better. They may stop going up, again, coming from that inflation to stagnation side, but it's really not going to get much better, especially in some of these regions over the near term, which is going to show kind of that need for, or the propensity for tightening, which again is going to eat into some economic growth and should start to slow things down a bit, which is becoming a bigger problem at the emerging market side, which is why we talk about the emerging markets so much. But when we look at the global manufacturing PMI, you can see that things are starting to flatline a bit. Now, they're still expansionary, but what is causing the expansion? Now, there are positives behind that, so we can't discount the growth because there is growth in general, and it's moving in a positive direction, but the pressure on capacity is continuing to build. And the reason why that's happening is because the average vendor lead time lengthened to the greatest extent in the survey history, while backlogs of work at manufacturers rose at a near survey record pace. So you have these supply chains that continue to be stressed, can't catch up with themselves, and that's really driving those prices higher, speaking back to inflationary pressures, supply chain going all the way back to Africa, Latin America, where we continue to see strikes at mines, people that are feeling really disenfranchised just given the situation that they're currently in. Now, when we look at the backlogs, now this also fed through to increased inflation, as highlighted by the steepest rise in input costs for over a decade and record inflation of selling prices. This is that connection between the input cost and then the prices received from the consumer, where input costs keep going up, and because inventories are so low, the company is beholden to whatever the supply chain will bear, and it's rising costs that they're going to have to continue to push down. But if you're already seeing those costs increase through your supply chain, then your ability to increase the cost of labor or pay people more is diminished, because that is just another pass through that you're going to have to push down into that price that the market just can't tolerate at this point in time. Now, on the other side, delays in the receipt of goods ordered from suppliers combined with higher production needs encouraged manufacturers to raise purchasing levels in May. So they're raising the levels, but again, struggling to find the employees or pay the people that, to come back, which is creating some of this disconnect that we're seeing on the employment side versus, on the labor front. and buying activity expanded for the 10th month in a row and to the second greatest extent on record. This led to a slight gain in pre-pandemic stocks for a second successive month. This is coming from their breakdown of the data, which I think is important when we're considering where things sit. Now, when we break it up a bit differently and look at the consumer, intermediate, and investment, the consumer still continues to lag. It's obviously back above those pre-pandemic levels, but we're seeing some of that friction point in terms of where the consumer is versus the investment cycle and the intermediate. So when you look at the investment cycle, it's starting to roll over a bit. It's still going to stay in a growth projection just because we see a lot of investment trying to replace some of the capacity, whether that be from the inability to get labor, trying to take away some redundancy and protect that cost. While on the intermediate side, we continue to see kind of that positive move. The issues are what happens with in that intermediate time, where are prices, where is some of that pressure going to come from? And one of the reasons why we started to get bearish in 2019, you can see how things were starting to really get pulled down, and now the consumer is really slow to come back up, speaking to inflation, the inability to really afford some of the rising costs, which is where we come to that stagflation side of when does the market reject price increases? And I think we're starting to get closer to that point, which is going to be a drag on some of the underlying dynamics or economics that we've seen on a global scale. So then when we look at that global output growth, this is where what can the market bear? And when we look at services, we're having services tick above where manufacturing is, which kind of led the way, and now services is starting to see some of that benefit. But again, services were also some of the hardest hit in terms of pricing. And now that pricing is getting a little bit better. We're starting to see some of that come back, where services we think is going to have a few more months of expansion while manufacturing continues to come under pressure overall. And the reason why is when we look at that supply chain delays. So global manufacturing delivery times, you can see that they're back to the highs during COVID, pre-COVID, post-COVID. It doesn't really matter. It's the highest it's ever been. And then the global manufacturing PMI input prices are pushing back to, on a global level, back to where they were in 2018. Now, we have seen some of those credit impulses roll over. We've seen some slowdowns in just underlying commodity prices, but just because they've stopped going up doesn't mean they're going to drop. And I think that's where we're going to see some of this disconnect, where we're just going to go sideways a bit instead of actually seeing a reduction. But as we've said in previous weeks, the delays between prices paid and prices received means that we're still going to see some of that movement down the chain, and we will see some of those increases in consumer prices, even though some of these material costs are going to flatline for the moment. And then that's when we start taking it, okay, well, what is happening within China and what does that mean going forward? So when we look at the ISM manufacturing that's turning back to the US, you can see that China typically shows or leads a little bit of the slowdown, and that's where we're starting to see some of this pressure coming down. Now we can talk about this going into Europe as well, but these are some of those leading indicators that we're seeing, that it just shows that not so much that we're going to get this big slowdown, but we're past a bit of that peak, and now we're going to see some of that pressure continue to drift to a level that will be a bit more normal. Now, with that being said, delivery times have not gotten better. They've gotten worse. Prices continue to go higher. So some of the negative things that are driving up PMI are going to continue to be there, but some of the more positive sides are going to start to drain out a bit, and we're going to have to look at those internals to understand, what is really the driving force. Now, another key component is, where are things going in terms of mobility? And this is, I thought, an interesting chart that goes back and really terminates in 2019, because 2020, 2021, we know what has happened in general. But when we look at just general mobility, what is the mobility side of some of these entities? And this factors into consumption, the means of consumption. And it's not surprising that the younger you are, the more you've seen an adoption of just utilizing the internet in different ways, and the speed or the algorithms that have been used from Instacart on down, that eliminates the need on the foot traffic or speeds up the process. And this is just something to consider, because this is all pre-COVID, and we've only seen an accelerating adoption of online consumption because you were forced to. And now people who were forced to over the last couple of months, let's just call it a year, they're now feeling confident that they can use this going forward. Now, will some of it revert back to normal? Absolutely. But there's going to be some of that stickiness that's going to change the way consumption is really happening. And this was an interesting chart looking at, well, how has it changed over that time period? And this looks at it from the perspective of U.S., Europe, and then key areas of Asia. And when you look at food and grocery and snacks in general, or just the way consumption is happening, I think this is the biggest one that's going to see a bit of that stickiness when we look at food and grocery and the way that is being consumed, because you're seeing more and more of that. Let's just use something that is repetitive, especially people who have children. You're going to need milk, eggs, things that you don't want to forget and have to go back. And I think you're getting some of that base built in. And the same can be said across a lot of that household side when you look at, different products, household supplies, because once you get into the system and it starts to interpret, or, especially after 12 months of data that has been collected on you, now it can predict, saying, hey, this is when you normally order. You should be running low on this based on your consumption patterns. And that I think that is starting to creep through. And it's not just in the US, which is an interesting thing. Some of these bigger areas are going to see an increasing amount of online consumption, which again is going to adjust the way we have that mobility and that movement through the system. And it's not surprising to see that as you have rising incomes, you have a greater adoption of online, just because you have this, you can afford the additional cost, because there may be some surcharges, especially for diesel now, that you might say, look, I'm just going to go drive myself. It's not worth paying this extra. Or I'm just going to go walk to the store because it's not worth paying the uplift. But as you have a rising middle class, or an additional, kind of that spare cash, you're going to see more of that adoption. Now, because the supply chains have gotten a bit better with that urban to suburban, because in the past it used to be hard, because if you were passing too many homes, which just means that, especially if we think about food, if that truck is only making 2 stops on that street, it still has to stop, and it's not going to stop as often. So there's less people to spread the cost of diesel around. But now if you're stopping at 10 homes, well, all of a sudden the cost becomes a bit more bearable, and you can adopt your supply chain to match that. And I think those are some of the interesting things that have been coming out of COVID, and we're seeing that learning on the machine side, machine learning, AI, starting to get that and starting to price some of that in. And when you look at millions of Americans switch to that low touch purchasing method, when you think about buy online, pick up in store, I think that's the one that has been the most interesting. But also that grocery delivery, store side, again, these are things that will start to get reduce a bit, but I think people are going to be surprised by how much or how comfortable people have gotten with this functionality. Which is why when we look at demand for food delivery stayed strong even when restrictions were eased. And I think this is the biggest key, because we've seen reopening, different areas have reopened at different periods of time. But even as we've seen some of that normalization, we're still seeing people order online. We're still seeing the demand for things like DoorDash, Uber Eats, even though you can now go to the store yourself, you can go to restaurants, and how this progresses. Now, again, will it normalize again? Absolutely. We're not going to stay at this level, but there is going to be a lot of growth that's going to stay within the system, again, because people may not be as comfortable as going into crowds, but more comfortable. So instead of maybe using, let's just say DoorDash 3 times a week, you'll use it once a week or twice a week. But again, there's going to be some of that stickiness that's going to stay within the system over the coming years. And this is just looking at the rise in online shopping, which has been accelerated. And this is just the adoption that's going to remain, because it was already shifting up. And then COVID was the force where, look, you have no choice. You have to do this. So even people who have, especially the older generation that has avoided it, had no choice. And then once they realized the ease of it or gotten comfortable with the functionality, I think that's where you're going to see some of that, increase over time. Now, when we look at that population shift, and this is something that I think is very important when we're thinking about population changes, and this is just looking at about China, because when we look at China, they've now adjusted their one child, now 2 child policy. People can now have 3 children. And it's because they're trying to attract or reach a birth rate of replacement. And one of the things that has always been designated is you have to have over 2.1 births to replace and start to see that population growth. And the reason why it's so important on population, when you think about, well, don't we need less people? Well, you have pensions, so you need people to come in, pay into the pensions on those that are taking out. And there's also a certain amount of economic slack that you need to be picked up in terms of jobs and really trying to drive that forward. Now, the issue is we're continuing to see a drop through in terms of that low, really coming between that low and middle fertility rate, where we're seeing this slowdown in China. So they're getting pretty close to the cap. And now you're going to start to see it really stagnate, which we started to see this year. And that's only going to accelerate, which if you think about what they're trying to do in terms of, adjust the retirement rate, trying to solidify or stem the tide of how are they going to maintain their manufacturing, they also need local consumption. And how do you get local consumption? Where more people. And if you think about having a child, I know I have 3 of them, so there is a lot of buying that comes in with having children. So that's also something that would provide some of that uplift, which is going to be interesting when we start going abroad and look at, okay, well, what is happening not just in the U.S., in China, but also within the other regions. So when you look at China's total fertility rate is heading toward the low end of estimates. China could raise its child, this is just a quote, China could raise its child policy to 10, and it wouldn't make much of a difference. Raising it from 1 to 2 in 2016 didn't substantially lift the birth rate above 1.5. Raising it to 3, again, is not going to do too much. And we're seeing this play out not just in China. This is something that is becoming a more of a global issue. And you're seeing it in the OECD countries, where a lot of their growth is really only being maintained by immigration, not by local, birth rates. And I think this is going to become a bigger problem when we start looking at, well, how are you going to fill those manufacturing jobs? We've seen jobs stay open. We've seen this breakdown of jobs and skills. And this is something that is only going to compound some of those issues as you just have less workers, as xenophobia, nationalism rises on a global level, and you stem the tide of the immigration. Well, you don't have that backstop in terms of, well, who's going to pick up those jobs? And we're already seeing that really bite into China specifically. Now, when we talk about some of the normalcy in general, the Asian nations are continuing to lag on vaccinations, which is creating some of this pressure when we look at the next wave of infections. There's not that vaccine to help stem the tide, where when you look at Europe and the US, as we came out of that second wave, we were met with a rise in vaccinations, which were helped to kind of tamp down and to make some of the progress we made on infections, really sticky and really continue over time, which is something to watch when we look at what is lagging behind and how is Asia going to respond to just finding ways to vaccinate the elderly and those at risk, to get some of that normalcy back into their system. And when you look at China and India, which are lagging behind providing the vaccines at home. So when you look at the US, a lot of that has been kept for domestic use. Some of that is now being turned into exports. But China and India have, even though they've produced a decent amount, some of that has gone to export. Same with EU. But now we're starting to see that turn back inward, and China and India will start to see that acceleration on vaccinations, which we'll talk about in the EIA show tomorrow. One of the bigger things, especially when we start talking about some of that reopening, the reopening has been a bit slow. And when we look at that slowdown, we just want to look at U.S. consumers' propensity to spend, and it really peaked April 25th. And when we, in the econ show, it's one of the things that we've talked about in the EIA show specifically, that we've seen that big push. We've seen that acceleration in terms of the reopening, but what comes next? And that's where we start to see some of this balancing act, because if you wanted to get vaccinated and do something, you did, but where do we go from here? And this is going to be something interesting when we layer this into trade data, as well as some of the growth that we've seen in terms of just the U.S. activity on the consumption level, which is going to be a big driver of future growth. When we think about what is the biggest driver of U.S. GDP, it's the C in that calculation, or the consumer. So we always want to look at what does consumption look like and how is it being driven going forward.